In mid-March, a wave of relief moved through the financial markets. The February Consumer Price Index, or CPI, a metric that tracks the average change in prices consumers pay for goods and services, showed inflation rising just 0.3% for the month. On paper, it was the specific signal the market had been waiting for. For the Federal Reserve, this manageable data point appeared to clear the final hurdle. It provided the statistical justification needed to move toward cutting interest rates and finalizing the transition to a stable post-inflation economy. This chart tracks the components of that report, specifically the shelter index, which measures the cost of housing. In February, rent growth slowed to just 0.1%, the smallest monthly increase in 5 years, removing one of the most persistent drivers of high inflation. With these numbers in hand, the outlook for the Fed's March 17th policy meeting seemed settled. The snapshot described an economy that was finally cooling exactly as the central bank intended. However, by the time this report arrived on March 11th, the context had already shifted. The economic conditions described in the February snapshot were based on a world that had effectively vanished before the data was even published. This is the inherent risk of a lagging indicator. A lagging indicator is an economic data point that reflects what has already happened, rather than current conditions. It is a rear-view mirror view of the economy, showing where we were, not where we are going. While the February report was being finalized, two real-time developments were unfolding: a significant weakening in the labor market and a massive, unexpected shock to the global energy supply. The Fed now heads into its next meeting, holding a reassuring inflation report in one hand and a deteriorating energy and growth backdrop in the other. The roadmap they were planning to use for a soft landing no longer matches the terrain. The first major contradiction appeared in the labor market. While inflation was cooling, the jobs data that the Fed relied on to support the soft landing narrative began to show unexpected signs of strain. This graph illustrates the change in non-farm payrolls. In February, the economy lost 92,000 jobs, a sharp reversal from the previous month's gains, while the unemployment rate ticked up to 4.4%. A deeper look reveals that the previous year's strength was significantly overstated. A benchmark revision, the process where the government updates preliminary data with more accurate records, showed that the March 2025 payroll level was actually 862,000 jobs lower than originally reported. This means the economy did not enter 2026 from a position of maximum strength. The labor cushion the Fed believed it had while fighting inflation was substantially thinner than the headline suggested. At the same time, the focus shifted to the Strait of Hormuz. Intensifying conflict in Iran has triggered what the International Energy Agency calls the largest supply disruption in the history of the oil market. This chart shows the price of Brent crude, a global benchmark for oil prices. With 8 million barrels per day removed from global supply, prices spiked toward $119.50, a level not seen since 2022. These energy costs quickly filter through the rest of the economy. When oil prices spike, the cost of diesel and jet fuel rises, which increases the price of moving goods and operating a business, eventually showing up in the price tags of consumer products. This pressure is meeting an inflation environment that was already proving stubborn. The Fed's preferred metric, the Personal Consumption Expenditures Index, or PCE, which tracks what people actually spend rather than just price tags, showed a firm 3.1% annual increase in January. When these new energy costs reach the consumer, they threaten to reverse the progress seen in the February report. The calm snapshot from a few weeks ago simply does not account for the inflation risks currently developing in the energy complex. As the March 17th meeting approaches, the Federal Reserve faces a choice between two conflicting datasets. The environment has shifted from a planned transition to a difficult management of two distinct risks. If the Fed follows the February CPI report and cuts interest rates, they risk providing more liquidity to an economy just as the oil shock is driving prices higher, potentially reigniting inflation. But if they react to the oil spike by keeping rates high, they risk putting further pressure on a labor market that is already showing its first signs of contraction. The Fed's dual mandate, to maintain price stability and maximum employment, is being pulled in opposite directions. For the first time in this cycle, the two primary warning systems are demanding entirely different responses. Institutional expectations are already adjusting to this new uncertainty. Goldman Sachs recently pushed back its forecast for the first rate cut from June to September, citing the rise in inflation risk caused by the Middle East conflict. This shift highlights a broader reality in macroeconomics. The health of an economy cannot be judged by a single lagging headline, no matter how reassuring it looks at first glance. Navigating these markets requires looking past the month-old statistics to see how they are colliding with real-time global events. The February data provided a moment of calm, but that calm was based on an economic landscape that has already moved on. The Fed must now make its next decision in a March economy defined by weaker jobs and a historic oil shock.